Hello, everyone. Here we are with another Bitcoin intelligence market review. This week we're going to talk about, like, following last week that we spoke about potential rally because of the spot market was showing some sort of like accumulation, especially using the URPD chart that looks at how the new investors are behaving at current price levels. It shows like a little bit buy the dip at sub 118, and then after that report price rally to a new all-time high actually, and that was like pretty impressive. Since then, like since midweek towards the end of the week, market start to correct from 123 all the way back to 117. I'm not sure if we had any I was not following the aggregated price level, but I'm not sure if on some exchanges we probably hit at 116 as well. But 117 has been the price level that we have been like trading around since then. So we're gonna look at why we think the perpetual market are gonna determine the next move, and what price level it would be the threshold between the current pretty bullish sentiment and the cautious or maybe bearishness from our perspective. So we're gonna like most of the time we're gonna start with the short-term holder price bands. Like this metric is probably the most go-to chart that I would use to begin think about what's next. As you can see, we spoke about these price levels a lot, but to review for the new audiences, the price in this model have been, let's say we want to see if Bitcoin is expensive or is cheap. That's the answer we're going to look for using this metric. As you can see, price level is hovering around a red line. That red line is the cost basis of the new buyers or short-term holders. That's the term coined by Glassnode. So using this price level and looking at price, whether it's above or below it, we can see price is pretty cheap or expensive based on the recent buyer's cost basis. And we can use this deviation as a gauge to see if market is euphoria or in a huge amount of unrealized profit that can trigger sell-off, or it is actually in huge or significant unrealized loss that can cause a seller exhaustion or possible low risk zone in the market. To do so, we are looking at the statistical significance of price deviation from cost basis, which is the red line. And as you can see, there's orange lines on top. Half a standard deviation is the first line, one standard deviation. Usually this is the range that tops are being printed in. Above one standard deviation, similar to what we saw in March 2024, that is extreme euphoria. Like above that, market is so fragile and we can expect a cyclical or semi-cyclical top in. But this range, half a standard deviation to one standard deviation, which is almost heated, we call it heated zone. That's where it might like takes months before market start to show some weakness, or it could be like a short period of time, like a January to early February 2025. So we're not speaking about the length of it, but if we hit the higher, if we continue to stay around the half a standard deviation and we see some resilience in the market, we can speculate about the next level, which is the around 128,000, and that's one standard deviation. So what happened since 123 is price broke below the half a standard deviation, but we're not seeing a sharp decline. We're seeing like price is around 117 and it's close to 120, which is half a standard deviation. We have saw similar behavior before. After we hitting a new all-time high, market shows some weakness, and that weakness might be a multiple month or it could be a very short one, similar to what we had in July 2025. So it's really about how long we're going to be there. It is pretty like hard. We have to use other metrics to see what is the bias from other perspective, from other metrics perspective. This is going to just help us to find the immediate support and resistance level, and these support and resistance level act as a magnet because these are the significantly statistically significant levels that markets is going to behave differently above or below it. So 120 is where the looks like the as we're gonna go through, the recent buyers are gonna like feel some pain, and if they start to sell as a result of that price stabilizing below their cost basis, we can say, okay, they are being spooked that they are selling. But if we see price is not breaking below that significantly or remain around 120 to 117, that means they're resilient. They're not selling. They're not reacting to frustration after seeing the price have not been continue going up above 123. So their behavior around this significant price level, statistical level, is a very key question to ask. What they're doing. So let's look at the 117 again from a closer distance. And if you look at the URPD, or if better to say, if we have all coins sorted out based on their cost basis and looking at what price they moved before and try to put them in different buckets, we can see the majority of coins moved above 108, like 108,000. They have been like moved by the short-term holder, obviously, because we have been not very long above 108. So looking at the big cluster of coins moving in that price, that is telling us this cluster is what we should look for, because it's been formed recently. As we talked about last week, we can see a little bit, a significant buy the dip around 117 or below 117 that is filling this gap. That is very positive thing. But what we are looking at is currently price is close to the model or the maximum accumulation price, which is around 117. So that being said, it is a very pivotal point in the market. That means if prices stay above 117 and get some support here, that means this big cluster is resilient and they are in this game for long term. And they're not looking into just sell as soon as they see some profit margin shrinking, or it's turning to a loss margin. So what we're seeing is they have been resilient so far, at least in the last couple of days, but breaking below below this 117, that opens the door. Okay, we have to probably look at the next big cluster, which its model is around 104. That's been the case that 3 weeks ago we talked about. We were saying, okay, markets show, if it shows further correction, it was around 114 or 110, I believe, 112 actually. We were saying, okay, if it breaks below 112, we should look at 104. But right now we're seeing that cluster around 117 is denser and denser, which is positive, but that makes 117 level very important. Now we're sitting on that price level is a pivotal point, and we can follow this chart on a daily basis. If you have any paid subscription to data provider, you can even watch this on a hourly basis. But most of the data provider look at the they filter out the intraday moves and just look at it on a daily basis because it's going to be so noisy. 117 is very important, and looking at the supply that's in loss, which is around 5% or 4.3%, it is still not that is significant that we can talk about, a big chunk of supply is in loss and we should expect some sort of like capitulation and further correction. So far, that correction has been pretty normal post the new all-time high, and 117 is a very key price, and we're going to talk about furthermore about 117 using the futures market. But so far, the spot market did the job. We rallied above 120, 100 something. 120 was actually the half a standard deviation. We got to the heated zone. We saw like a post all-time high kind of cool down. Now we're going to explain why we believe the key is in the futures market hand, like why we think the second leg of this rally is really relying on whether the liquidity being introduced to the market by the mostly leverage speculated in the futures market. They can push this price higher, and we have to monitor and give more weight at current stage to their indicator. Before moving into futures market, I would like to talk about the cool down that we experienced after 123 and how market is acting as in terms of profitability, and then talk about ETFs. Then we can go to the main part of this article, which is focusing on the futures market. If you look at the realized profit and loss and see how investors reacted actually during this, I have to play with the price to show you how price moved up and down. If we look at let me zoom actually at the price and then bring in the profit and loss taking. You could see after market start to rally from early August from 112, start to rally to the new all-time high. the profitability of the people who are active or they're reacting to the price start to actually double since that low. I think it is the 7-day moving average. I have to check with my great friend Checkmate. I'm pretty sure it's 7-day moving average. So it's almost 14,000 now, around 14,000. So it's doubled from its base, meaning the recent rally was actually triggering the profit taking or profitability market and revive it. Because if we were going lower, we were almost on the base level. So if we were about to correct further, about beyond 112, that profitability would break below the baseline in this bull market, and that would cause like a warning, that would trigger a warning sign. Because if the profitability drops below the baseline that you established in a bull market, like what we see here, for example, if we break below, that's going to be a canary in tunnel, and it's going to be a sign, hey, the profitability momentum dropped below the baseline, and we cannot expect a sharp recovery in the market unless something super optimistic happens. So the rally around 123 was a savior for bulls, because that profit taking was on the verge of breaking below the baseline, but it didn't happen, and market started to rally and increased and caused and created an opportunity for people to see some profitability. And that's going to be like a closed loop scenario, and more profitability means more buyer can come into market. So that is a very positive, constructive change in the profitability. But we have to first of all measure this baseline every now and then, because it is changing, is very dynamic. We should not use a baseline that have been established over 5 years, but instead we have to focus on last 6 months, last 1 year, because the nature of this market is so dynamic. So we have to use shorter term to measure, even by like visually, we can, or mathematically establish the base. If the profitability stays above the baseline, which is around 7,000 BTC, the net net realized profit, that is a good sign. And we have seen that baseline have been kept during this rally, and even now the moving average still is heated. We have to see what's next, but as far as we are above 7,000, the momentum or a confirmation of the momentum is there, and we can monitor this on a daily basis. So far things good. So 117 is not like end of the war. I mean, people were crying about breaking below 100 a couple of months ago, and now we are becoming bearish when price breaks like below 120. That is very fascinating, that Bitcoin can change the scene, and you can change your expectation so fast with price. And that's the human psychology, which amazes me all the time. And on-chain data is showing, like, and when you compare the move in on-chain data and the sentiment in the, for example, Twitter, you will see how fragile our perspective is when the price moves. Like, we are talking about 140 when price was going towards 123, and then right now you could see when we broke below 120 and we are 117. I didn't do a systematic analysis, but you could see by like most of, I mean, I cannot confirm it now here, but you could look around and see the accounts that we're talking about 140. Some of them are talking about 110 or sub 100. So it is very fascinating how fast we can change our perspective. But we try to use data and see if we can extract more like data-driven conclusion from this all these charts and metrics. So seeing that positive structure in the market and seeing the profitability remain above the baseline, we can move on to the ETFs. And because we were concerned actually 2 weeks ago when the ETFs net flow turned negatives, meaning they were selling or they were capitulating somehow. At least portion of them were selling at like 113, 112, and the net flow turned negative. That means the demand on a net basis turned to sell side, and demand side over there was exhausted, and you could see they were selling, and that negative net flow usually could be a sign of multiple week of weakness in the market. But surprisingly, that rally, the sharp rally to 123, turned this almost negative point. I think it was 600 million or 600 something million, 642 million net negative sell-off, all the way back to around half a billion or 547 million net positive inflow, which is showing how fast the sentiment in TradFi can change as well as like the traditional crypto native investors. As you can see, now we got back to the positive net flow. That means they're buying, and that is another positive sign in the spot market that we were looking for. So spot market again had a very strong say or impact on the recent price action and push the price all the way to 123. Now we're going to focus on the futures market, which most of the time they are a little bit lagged. As we talked about it last 2 weeks, there was some lag, and we were hoping that momentum actually being seen in the future market. The scene is ready, as I'm going to go through the futures market. The scene is ready, but we're going to talk about what is the upper and lower price levels, that if we break below or above the upper level, that means that's a confirmation or a early warning for the end of the recent spot driven rally. First of all, we have to look at the funding rate. If you look at the funding rate, that's pretty interesting because let me zoom in on the funding rate. The recent rally to 123, let me turn off the parallel indicators, push the funding rate. This is annualized and around above 10%, which is usually above 10% was where the market entered a euphoria, or where the price was rallying and the liquidity was driving from the futures market. What had a significant impact on the price as well. I'm not saying it's only futures when we break above 10%, but the futures market become a driving force in the rally as well. So we broke above 10% temporarily for a couple of days, and that was very positive. But with price showing some weakness after, the funding rate dropped to 6%. Similar to what I was saying about profit taking, if you zoom out and look at the recent funding rate, you will see the 5%, almost 5% is the baseline between the heated market and the, like, I would say, bear market from futures market perspective. When around 5% or below 5% is where the bulls or the people who are paying the interest to keep their long position are not in the market anymore. So they lost the appetite. So that sharp drop to 6%, it could be a little bit like stressful, but we have to look at other metrics. What we have to look at is if we stabilize below 5%, 6% funding rate annualized, then we can talk about, hey, look, we have been a couple of days, we saw a capitulation and we saw a negative funding rate. That is usually a sign of multi-week to multi-month like bearishness from futures side, which can lead to less liquidity in the market, which can lead to like some weakening in the price action. So far, similar to profit taking, it's above the baseline, and we have to monitor this very closely on an hourly basis. Even if you want to, you can do a 24 hours moving average for people who have access and systematically are following this data. So if we see the 7-day moving average, if they're using the hourly one, 0.1, I think it's 0.01%. That's the neutral value if you're looking at the hourly basis. If you look at the annualized, around 5%, 6% is where we should look at the funding rates if it's breaking below or staying above it. So funding rate is again at a pivotal point. It's if it breaks below this, that's a early sign of long side of the market getting frustrated or losing momentum. Also, we can look at the funding rate, the liquidation heat map, which is a very strong tool to look at the recent. Let me look at the recent open positions. What is their bias? Like where is their max point, max pain point, and where their position will be liquidated massively. So if you look at the recent data, you will see. Let me see. Let's focus on last month. Actually, that's going to be easier to follow. You will see if for BTC you can. I'm pretty sure you can try all assets. Yes, they have all assets. With the price rallying from 112 to 123, you could see a huge cluster of shorting parties. Like the short side of the market got liquidated around 120. So that was very significant. And then market corrected slightly to 118 and then rallied to 123. Again, another cluster was liquidated, or better to say forced to close their position. After then, we saw market start to have some contraction towards 117, which we explained that is a very dense price level from the new buyer's perspective. Accumulation that they accumulated a lot around 117. If you look at the change in the cluster below the price, which is showing the liquidation point for the longing takers in the market, you could see it's getting denser and denser, especially around like 111, 112. But what we care about is this OI, the new OI, just coming into the market, getting dense on the lower side of the below the price, which is the long side of the market. As you can see, this shorting party have not started to open position. They started to slightly open some position around 120, but it's not significant. So that means the futures market, recent buyers or recent investors, because they could bet on the short side and long side, they're mostly biased towards the rally continuation. You could see the long side is getting denser and denser, much faster than the short side. That being said, sitting around 117, we are very close to the cluster that is long in the market, the high leverage speculators max pain point. What we can conclude from this chart is the bias is towards upside. Like you could see, a lot of the new position open is bidding on the upside, but also there is a short-term risk that is growing actually, and that is price breaking to this cluster, because their max pain point is very close to the price. And recently they launched this table that measures the max point, which is the most like the model of this cluster. If you show the distribution of the positions by their size and thereby cost basis, you can find the model, which is visually almost easy to find, but they mathematically measured it. If you take the last 2 weeks of position open in the futures market, you could see the max pain for long side is around 116, which is very close to the price, and the max pain for the short side is around 120. That tells you, okay, the growing part of the OI, which is happening like right now as we speak, is showing the biases toward the upside, but the short distance between price and the max pain of long position means the risk of breaking 216 is growing as we speak. So what we should be concerned about is if we lose this 117, 116, there is a high chance at least we get to like I think, but let me use the supply thing. Yeah, we get it towards the midline, which was around, I think it was around 112, 113, and it's changing on a daily basis. But if we keep above 116, as far as we're above 116, and we don't see this long squeeze or seeing the bulls getting attacked by the price, we have a very high chance. Staying above 160 is a very high chance, and we're well positioned to see another leg up towards one standard deviation, which is around 128. So the conclusion I want to make is the spot market, especially the ETF, I mean, we can highlight ETFs, showed a very strong momentum, or they supported the price all the way to 123, which was pretty amazing. And then we experienced a little bit sell-off, a slight profit taking, which is again positive at current stage. We're way below the extremes that we had in previous all-time highs. We have not seen that extreme profit taking plus 20,000 plus up to 40,000 BTC net realized profit. So this is a positive. We have to monitor it. All this positive in the spot market was making the scene ready for another leg up. Right now, the ball is in futures markets court, and we have to see if they're actually showing the same positive momentum in terms of liquidity towards upside. The new move shows the short got squeezed pretty well at 120. There's not much happening above the price. The short position most of them got minced with price going to 123. The OI, the recent OI, is pretty biased towards upside. There you see their betting is actually towards upside. That being said, the risk of breaking below 116 is very, very significant if we keep seeing this price is just hovering around 616 to 117, 118. We really want to see price get above this cluster again, 120, and then we can talk about 128, and we should follow the on-chain short-term holders statistical band for every week from now on to see where we are in terms of like the general sentiment in the market. So far 116 is very significant. We are worried about price breaking below that, but as far as we are staying at 116, especially with the great rally that we had, which was driven by spot market, if we see this price is reacting to this accumulation and the futures market is still have some liquidity to face the like a small weakness in the market that we saw over the last week and towards the end, and the I don't know what's going to happen tomorrow, but if we see the sell pressure in the futures market have faced enough demand on the futures market, and we see that positive momentum that we saw in the spot market in perpetual market as well, then we can speculate about the one standard deviation, which is around 128. So our direction is aligned with the market, especially futures market, and it's towards upside. But this direction, this bias is going to be totally reconsidered if we see price breaks below 116 and a half more than a couple of days. Then we have to renew our framework and look at, okay, what's next. So far everything looks good, and I wish you the best bull market that was talked about last week. This has been a very long bull market, and I wish you just use this data to your benefit and just make the best decision that you can make. Have a good week and see you next week.